Hey guys, welcome back to the After Hours. I'm the ATL Beast, and today we're going to talk about normalizing holding your trades. There are a lot of beginners in this channel, and when you are a beginner, you're going to make a lot of mistakes. We know when it comes to trading, it's all about preparation, and you are asking the right question. When you come to the market, you're asking, what is the market offering? Every day, you are there to do the investigative job. When you're doing the investigative job, that's to see how much can you take from the market and how much are you willing to risk to get that amount. When we ask what the market is offering, we understand that we are looking for patterns. Pattern is king. And when we talk about the king of patterns, we know that it controls the entire flow of the rest of the day, because most people are looking at the same pattern. They might call it a different name. They might just be looking at a specific resistance or support or even following price action. But when you put all the pieces together, it's usually some form of a pattern. Now we might see stocks that start out as one pattern and then they translate into a different pattern. Now there's a lot of times where we're looking at a breakout that happened in the pre-market and everyone's looking for the pre-market breakout. But that pre-market breakout, if things turn out all right, the next day, it might turn into a resistance play. We're talking about an overextended short. That overextended short, maybe it actually doesn't come back down right away. And then it carries over to the next few days. And then it becomes a multi-day runner. Let's assume we never even got to the second or the third step. Instead, the breakout became a parabolic. And it went to $50 or $100, all the way from the single digits. At that point, you're looking at a parabolic short. What happens is, if we're talking about what do we do in this situation, we have to understand every price action, you should have your own rule. So as a day trader, we are rule-based. You could be a profitable trader or you could be an unprofitable trader. Now they're all completely different, but what you want to do is find consistency. We want to be profitable and consistent. That's the ultimate goal. And the only way to do that on a consistent basis is to have a process, to have a plan, to be prepared. All of your work should be in your preparation, but there's a big step in between whether you actually execute that plan, because you're human. This goes especially for the beginners. When you have a trading plan, maybe you're risking $100 to make $100. Well, if you have a win rate of 50%, you can make several trades and pretty much break even. If anything, you actually might lose more. Because if you're a new trader, there's a really good chance that you're probably letting your losers run and you're taking your winners too early. You don't have to have the best math skills inside of trading, but you have to have excellent organization skills as well as discipline. Whenever you're not profitable inside of trading, it's because you lack the discipline. This is the most important part. You lead with risk management. If you make more money than you lose in the long run, you should be fine. So let's talk about what happened this week in the market. One of the things you have to know is that we had a lot of plays. We had a lot of volume. Now, when it comes to these plays, you have to understand that most of them were low floats. Now, when it comes to low floats, biotechs, we do not focus them. But when they show up, we understand that with the high risk, there is opportunity. Now, ADIL, this stock had a massive resistance. We're talking about it had 111 million volume up to $2.84. When I saw this, I thought, oh, this is my opportunity to make some money. But then I looked at it and it was a biotech. And I'm like, I don't trade biotech anymore. It's just so blah. And so what actually happened is I traded it. Now, when I traded it, I lost money. But when I traded this, I actually was up. I top-ticked it. I top-ticked it with my starter. And then I averaged down on the position and I averaged in too much. Now what this looks like is I went in here shorting the pre-market high. And then when I added somewhere around 350. And so instead of getting my profit target, which was 280, something that was very reasonable, I ended up getting stopped out when it went to 270, which really sucks, because if we looked at the 1 minute candle, we're on the 5 minute right now, but if we were able to look at the 1 minute, you would see some stuffing action on this candle. Now, with that stuffing action, that's normally my chance to go in. That's the confirmation of a failed reclaim of a key level. Now, when you're in an oversized position, that ends up becoming something that scares you out of a position, especially if you made mistakes before that point and you lost confidence inside of the thesis. Now, that's what happened to me with ADIL. I went in and thought, this is a pre-market high. This is a delayed activation of a massive resistance. I could do anything and I can get away with it. I had all the confidence in the world. It matched the pre-market high. Well, I actually only went in on that starter position at the pre-market high because I expected it to go to 450. It fell in early was an even greater sign that this was a strong play. But I forgot all that. I blacked out. Now, the reason I blacked out is because this stock, when I put in that starter position, it went all the way down to $3. That's a whole dollar that it went down on a $4 stock. You know what that means? That's 25% off the top that it went down, which is crazy. When it did that, I chased on the smallest bounce. I'm talking about I added around 320. Now, the second time I added, it was somewhere around the 340 area, thinking that this was the only bounce that was going to happen. Well, even before these bounces even happened, I actually wanted to get somewhere around 350 for my bounce. But by that point, I already messed up on my second entry, and that led to a lapse in judgment on my third entry. Now, none of that would have happened if I just left my starter position to do what it's supposed to do and just start the trade. Now, with that second position, I was supposed to wait till 350, but instead, I ended up putting a little at 315 and another one at 340. Both of them not even close to my mark. So whenever it comes to these positions, you're supposed to enter into strength. But me, I didn't even enter into a lot of strength on the second position or the third position. The only one that actually had decent amount of strength and volume was this big squeeze at 380. Now, that was just one stock. Now, there's other stocks that I traded. Now, if we're talking about what I traded today, it was based off of what happened last week. Now, last week, we saw more resistances. We're talking about, we saw a resistance of 86 million. Now, with that 86 million, I used that today for a bounce short. What this was, is a double top. It didn't actually get all the way there because we have to recognize that 80 million is a lot of volume. So it's expected to fall early. And then this one went up to $4. So I put in the position at $4, risking the 20 to 50 cents. Now, I personally wanted to put in 50 cents, but it all just depends on if I went in cash or if I borrowed money through margin. Well, I just put in cash. So I was able to risk 50 cents and my average was around 384, which means I could risk up to 430. It only went to 420. So we're going down. It's going down for real. When I got out, I did a quick scalp. Now I did that because I was down on my last trade and that affected what happened this trade. Now you shouldn't let that happen. When you go in, you might want to hold the whole day, especially if you already have your risk in mind. Now, here's another trade that I did. This is AISP. Now, AISP, this was a trade that had a resistance. It's a common thing there. Now, the other ones were a bounce short. This one was a gap up short. We're talking about this one had the minimum 18 million resistance, and it was pretty far in the past. We're talking about 2 months. Now, with that 2 months, we saw that there was a massive green day. That massive green day, that's where I shorted. Now, when I shorted, we understood that that green day, it only went up to $3. Now, in that morning, we saw it gapped up to $3. And we saw that previous resistance around $3. So we're thinking, oh, okay, we can use that as a resistance. But at what point is it going to be a pattern break to where we don't want to trade it anymore? Well, I already told you, it all depends on the price of the stock. Well, if this is a $3 stock, I'd rather do 20 cents. But when I really want it, I'll do up to 50 cents. Which is 15%. Now, with that 15%, I'll definitely size down. And that's what happened. I ended up getting stopped out. The last one I traded was LYT. Now with LYT, this one, it was just massively gapped up. There's nothing to really look at in the history. It's more of, it was just really overextended. Now with that overextension, we had no clue where this is gonna go. And how do you trade parabolics like this? The short answer is, you don't. Or you wait for some type of confirmation of the top. Now that's up to you for what that could be. It could be a certain indicator. It could be a certain price action, but you need it to confirm the top. And that's what happened here. A lot of people were waiting for a massive squeeze and it to consolidate for an hour before it broke down. When we see consolidations, we understand that consolidations bring in volume. Now, if we have a peak matched with increasing volume, that becomes heavy. And it's so heavy that it ends up fading the stock. We expected this to actually stop around 12. Now, when I went in on this, I went in closer to 11 and we wanted to get out around 9. But in reality, it didn't work like that. It came all the way back and broke 12. Now, when it broke that 12, all hell went loose because it went straight to 15. Everybody was loaded in around 12 and we're expecting it to go to 9, bounce back to 11, 12, consolidate, and then go all the way back down to where it came from. Instead, it doubled all the way to 18 and then consolidated. Then it went back to where it came from this morning. Now, because of all the shenanigans, we expected, okay, it had a 200 million volume day. That's not sustainable. I thought maybe I could short it in the morning. Well, I'm glad I didn't because this had a gap down in the morning. Yes, there is an edge there, only for that first hour and a half, because it came all the way back and cleared out everyone before going down again.
Interested in trading like Steven Ducks? It all starts with choosing the right broker. Ducks Trading has partnered with Centerpoint Securities to supercharge your trading journey. By joining Centerpoint Securities through Ducks Trading, you can unlock CP Edge, a suite of top-tier trading tools valued at over $6,000 right at your fingertips. Gain an edge in your trading with real-time scanners, cutting-edge news, and a personalized trading journal. Experience trading like never before, with superior short inventory, dedicated support, buttery smooth trade execution, and the opportunity to earn interest on any of your idle funds. Plus, enjoy competitive pricing that suits your trading style. Ready to elevate your trading? Simply click the link in the description below to get started. Now, let's dive back into the content.
We understand that when we talk about consistency, we're talking about the frequency at which you win a trade based off the pattern. And the pattern gives you what the market is offering. Now, based off of the pattern that you recognize because of certain criteria, you're going to see that this pattern is about to happen. And there's going to be an entry window. When the entry window happens, it's up to you to follow your plan, both risk management and reward-wise. When you enter that trade, you might be looking at price action. We're talking about buying into weakness or selling into strength. Now, we have to do this because we're there to get in a good position. And no matter what, you have to have some form of risk. You need to have 2 levels of risk management. The first one is your account risk. How much per day are you willing to risk? Is it 5%, 1%, maybe even 10%? That's a little crazy, but people do it. Now, a second form of risk management will be on the pattern level. How much wiggle room and price action does the pattern allow before it's a pattern break? What other indicators tell you that this is going to be a pattern break and that now you should size down or size out completely? But when it comes to money, we know that it's always going to be an emotional thing. And that roller coaster is something we don't want to ride all the time. And so you have to ask yourself, am I doing what my strategy was designed to do? Now, when we look at the day trading pattern, we have to understand that it has variations to it. Each phase of this pattern can be shortened or lengthened. And because of that, you need to find averages. Now, you can do that with statistics, but the more subjective you make your trading, the less clarity you have on your edge. Another important question that everyone has to ask themselves: what is the price of financial freedom? Is it courage? Is it commitment? Is it dedication? Is it constant vigilance? Short answer is yes, but we all can wrap it up as discipline. If you are not making money inside of the stock market, it's because you're not disciplined. Everyone doesn't know whether a stock's going to go up or whether it's going to go down. And there's several types of price action inside of the market. There's parabolics, there's steady grinds, there's range bound markets. You can even break it down to specific candle types, but mostly we like to keep it on the daily, looking for those breakouts or confirmations of support and resistance, as well as reversals. When it comes to trading, everything has to be simple. We're talking about you can risk based off the dollar or every 50 cents. Even every 20 cents. It's whatever works for you. And you have to have samples for statistics to give you the confidence to do this over and over again. You just have to make sure that your pattern has a thesis. And with that thesis, you want to support your thesis. What parameters? You're going to have entry parameters. You're going to have exit parameters. You're going to have conditions that equal a pattern break, as well as when the pattern transforms into a different edge. We have to understand risk management goes through 2 phases. One, there's the fixed phase where you're just trying to become consistent and profitable. Let's say you gave yourself 2 solid attempts to make this trade work. Well, that $500 gets split in half. Now you have 2 separate attempts that use $250. We want to make more than $250 when we win. We have to come up with a thesis that has more than a 1-to-1 ratio using that $250. And the way we can do that is we use a position size of $1,250. Because if the thesis called for a max loss of 20%, we know 100% will be $1,250. Now let's talk about the pattern. Now, when we look at the pattern, we like to think of it as a resistance, especially bounce short. Now, when we look at bounce short, it's a little different than gap up short. We're talking about we're hitting a wall of resistance. And with that wall, we understand it like a dam blocking water. When there is a crack inside that dam, it gushes through and it's a breakout. Now, we're not talking about a fake out, because when we look at gap up shorts, it always looks like a fake out. It's like shooting water into the air. You expect it to come back after testing 2 or 3, maybe even 4 times and then coming back down. But with a bounce short, it's different. Once there is weakness, it's the confirmation that the wall is there. So we want to treat it differently when it comes to sizing technique. When we talk about sizing technique for a bounce short, we want to hammer it hard. You might start your position closer to the open, or into strength. But when we get the confirmation of that resistance, then we hammer it home because our edge is that resistance holding, and we're betting on that resistance holding. We have to come up with pretty clear rules that says this resistance is broken. In my case, I might be waiting 15, maybe even 20%, depending on the price of the stock. All right, guys, that's all I got for you today. If you like what you saw, hit the like and subscribe button, and I'll see you in the next video. Peace.